Now we can start. Good evening. This is our first session. Now, before starting our first lecture, I want to explain something about our financial modeling subject. And then there are some particular requirements. Then you have to follow that. First of all, I think you have to keep your mic muted. Otherwise, we can't continue our sessions properly. So then, if you have any questions, I think you can make a comment in the chat box. Then the subject is financial modeling and forecasting. Already you have done a number of financial subject in year 2, year 3, and now in the final year. Already you have done financial management subject as well as financial mathematics, corporate finance, IFM, business valuation theory and applications, and some other related economics and accounting subject. So those are actually very helpful to develop the model. So here the sessions are scheduled every Friday 5 to 8, and tutorial classes are scheduled on Friday 3 to 5. Then lecture panel, myself and Ms. Nilangi also conducting some lectures, some topics. Then Abhita and Miyuki, they are doing some practical sessions covering some different areas. So prerequisite here, we mentioned that financial models and example will be developed using Microsoft Excel 2007-10. So this course is designed especially for those who are familiar with Microsoft Excel at an intermediate or advanced level. So you must be familiar with the Microsoft Excel. So that is the first requirement. Then the use of Microsoft Excel for designing financial model is emphasized rather than how to use Microsoft Excel in a generic sense. So we emphasize how we are going to apply in financial model development process. So in this context, financial mathematics is a prerequisite of this course. So you can't continue this course without doing the relevant subject. And also, in addition to financial theory-based courses, including financial management, corporate finance, business valuation theory, and applications. So those are the prerequisites. When we develop the model, we develop based on different theories, maybe corporate finance theories, maybe valuation theories, maybe some other related economics theories. Then you must be familiar with the previous learned theories. So in that case, mathematics is more important. All the theories and the explanations, formulas are developed based on some mathematical process. So that is a primary requirement. Course description. Objective of this course is to provide you with a practical perspective of financial theories and models using Microsoft Excel. It focuses the use of spreadsheet-based financial model designs methodology, utilization of financial theory over a wide range of applications to be used in finance industry. So basically, we develop the models based on the spreadsheet, Excel worksheet, and we develop some model based on some design methodology. So methodology means maybe applying basic financial theory. Then in addition, we can utilize those theories over a different kind of applications. For example, we can say that free cash flow analysis, business valuation, company valuation, securities valuation, like that. So optimal portfolio theory designing, that may be different kind of application based on different theories, finance theories. The emphasis is on simplicity, modularity, and ease of use. Normally, this is a basic course. financial modeling course. So our purpose is to continue the developing the model based on some particular concept like simplicity, modularity. We develop based on some different kind of models. So other things we observe how to be use in practical scenarios. So while making use of Excel features to speed up development and reduce errors. So ultimately our purpose is to reduce the errors and give some more accurate guidance through model development. The course provides students a career path in finance services, including debt and equity, investment banking, portfolio optimization, corporate valuation and analysis, research and consulting. So ultimately, the subject will helpful to find your career opportunities in different scenarios, debt and equity selections, investment banking, portfolio selections, corporate valuation like that. So otherwise, sometimes maybe research and some other consultancy service. So internal learnings, 3 points are mentioned. After completing this course, you must understand critical role of financial functions in developing forecasting models and familiar with key Excel functions in constructing such forecasting models. So you must understand how to apply finance functions in different scenarios, different areas. So first you have to identify what is the critical role in different career options, maybe a analyst or maybe some corporate financial executives. In such a case, how to perform your career with your finance related functions. At the same time, you must be familiar with the key Excel functions, how we apply the available functions when you take some particular decisions, when you're constructing your models. Second one, in addition to available functions, you must be able to build more realistic forecasting arrays and models. Sometimes that may be a particular model or maybe some particular development. In Excel, we discuss how to develop different arrays based on some finance theory, finance formula. For different corporate and personal finance decisions using best model structuring techniques. So that may be not only the corporate level, that may be your personal financing decision. For example, when you plan your retirement, how you are going to develop the particular model, then you can decide whether that particular model or the things more reliable or feasible like that. Then the third point, learning outcome, third one, apply and analyze more complex issues in financial forecasting and create forecasting models. So in different scenarios, there are different applications, different issues are there. So in such a case, how we consider and develop the different models and create forecasting model. In most cases, normally the subject we develop some forecasting models actually based on the past data. Method of delivery, lecture sessions, lab-based lectures and practical sessions, and student-centered virtual classes in case of unresolved global pandemic. So now we have faced that particular issues in the environment. So we conduct our lectures through internet, online. So in other case, if that particular issues are resolved, then we do our lectures in the lab. students are strongly encouraged to bring their laptop computer to every class. So when you come to this online or whatever the sessions, then you must bring your laptop or computer. So all the discussions are based on Excel. So you need to have a laptop. Method of assessing ILOs, practical quizzes, assignments, online or computer-based test. So later we will decide what are the exact assignment, whether it is group or like that, or maybe sometimes computer-based test or maybe online test. So Excel we will decide what is the whether it is online or computer-based one. Then required text here mentioned Simon Beringa, Financial Modeling 4th edition, 2014. But they're not much taken from the Simon Beringas, but we developed some carry out our discussions based on different scenarios. There are not much sessions are taken from the Simon Beringa, but however, that is one fundamental text based on the available Excel functions. So if you develop your Excel model or arrays, so then we have to arrange in different way. That text explain how to apply within taking using the available functions, Excel functions. Then in addition, there are supplementary readings, building financial models, principles of finance with Excel, financial modeling and valuation, practical financial modeling, elements of forecasting. Those are some similar text. You can, if you have access, you can read those. Then lecture sessions are scheduled. This is a tentative schedule. Today we can discuss the initial one, overview and modeling process, model structures, input, workings, outputs, key drivers for modeling like that. Then second, key Excel functions used in financial modeling. So we can continue our sessions for the next time also, sometime maybe not finished today. Then we have to continue the same topic. Then next one, key Excel functions in financial modeling. That is all continue the same thing. So initial part we discuss based on the available functions and how we concerned how developing our initial equations like that. Then sensitive analysis with two variables. Then data table, one or two dimensional data tables, goal seek functions, solver functions, like that. So those are different kind of sensitive analysis based on the one variable or maybe changes in two variables. If there are more than two variables, we discuss in different applications using some different Excel features like spinners, options like that. Option, there are different kind of option buttons. So next one, time value of money and cash flow analysis. So that is based on our initial discussion in the common program. So in that case, we discuss the different applications. Fundamentally, we know the present value, future value, annuities, present value of annuities, future value of annuities, and some different cash flows. So maybe continuous cash flows like that. In such a case, different trades, inflation rates, maybe real rate or nominal rate, the constant discount rate, different discount rates in different periods. If there are more time periods. So in classroom, we assume there's a one particular discount rate. So practically, we can't expect the same rate for a 5 year, 7 year, 10 years like that. We can't expect. But practically, we have to face changes in the market. So based on that, we can discuss different calculations, model development based on general rates, different rates in different periods. So time value money concept actually we enhance with this particular cost modeling. Basic functions, basic calculation part we have already learned. Then spreadsheet model for bond valuation. So here also different bond features, then yield curve, pricing of bonds, determining forecasting rates. There are different time periods, determinants of time period like that. Then spreadsheet model for bond valuation, average percentage rate, effective annual rate, yield to maturity, dynamic chart. So fundamentally, we have learned that average percentage rate, effective annual rate also we have learned, but practically how we develop the different models based on those concepts. Then spreadsheet model for stock valuation. The topic covers two stages, two-stage, multiple-stage model and dynamic chart. So in finance theory, you have learned two-stage model. When you discuss the dividend discount model, then you have learned that two-stage, supernormal growth, constant growth like that. So there can be multiple stages, more than 2 periods. So in that case, we can apply the developing the model based on the different assumptions. Dynamic chart also. Then simulating stock prices and volatility. Topic covers estimating stocks volatility. Geometric Brownian motions model. Portfolio optimization model. So there are some other models, maybe Black-Scholes option pricing model like that. So we apply one particular model in this class because if the time permits, we can discuss our topics extending to other areas also. Corporate financial planning. In most cases, the financial model discuss the financial statement-based model. So financial planning part. So here also we discuss the same topic. Operational worksheets, revenue drivers, average price conventions, income statement, revenue-based and output-based assumptions, accounting-based valuation multiples, statement of retained earnings, balance sheet, statement of cash flows, integrating cash flows into statement reviewing, reviewing interpretation and making decision-based output. Then the last one is review session. So in addition, here indicated in the second table, assessment tools. There are a number of assessment here. First one, cash flow estimation and analysis. So this evaluates model-related design knowledge based on the sessions in week 1 to 4. This is an individual assessment. Due date is here mentioned in January, but we can think if we complete the 1 to 4 sessions, then we can expect the first assignment on 2nd January. But if we can't complete the 4 sessions within this period, we have to change the deadline. So in this case, students should develop finance model for multiple cash flows, give model output. Marks are given based on the model design and interpretation part. Second assignment is based on the business valuation. I think all of you have done business valuation course. Now, it is based on the published financial statements, selecting the public quoted company, either local or foreign. 5-year financial figures should be gathered and firm valuation should be done based on the model. So you have to value a particular company. That is in, you have to submit that in March, 20% marks weight. The third assignment, medical insurance and retirement plan. So we allocate one particular medical insurance scheme, then that may be a group assignment. So I will give you some instructions how to develop that, how to make some different assumptions. Then based on that, you can develop the retirement scheme. Insurer must develop different models output based on key assumptions for medical insurance and retirement. Or otherwise, you can select either medical insurance plan or portfolio optimization assignment. So this is a construction of financial model for portfolio investment based on equity investment. The sample firm and data will be delivered and decided by the lecturer. So we will decide the data set, sample period. Sometimes we can distribute the data also. So here students should develop optimized model first based on assumed investment proportions and then based on self-administered proportions. So 10 marks are allocated for the assignment. Then final exam. So here not mentioned that midterm examination, but in addition to this assignment, we have to face one particular online or computer-based examination that consists in multiple choice questions. Then practical sessions are scheduled. Here you can read that Excel function used in the financial model, sensitive analysis and two variables, sensitive analysis, creating and analyzing cash flows from investment financing activities, interactive sessions. So here, if there are some issues, in some cases, if you have any problems, you can discuss with your lecturer. You can discuss with your instructor. So here given, allocate some time for interactive sessions. So physically, if you have conduct the lectures, we go to each student and observe whether they perform well. In the lab settings, if there are weak students, we go to those students and observe and make some guidance. But here there is no any guidance as this is a virtual sessions. So if you have any questions, then we can discuss the issues. Then special spreadsheet modeling for bond valuation. Then spreadsheet model for stock valuation, portfolio constructions, interactive sessions. There's another two sessions, interactive sessions you can discuss here, instructor. Then corporate financial planning. then cost policies, attendance, grading procedure. In the grading procedure, here mentioned, continuous assessments, 40 marks, 40%. End of end-term examination, remaining 60%. Then out of that 60%, 60 marks, then you have to complete theory 24, practical 36. So at the examination, final examination, we prepare the questions for basically 5 questions. So you have to answer 2 questions, select in theory, and all the questions in practical sessions. There are 3 questions in the practical part, then marks are 20, 20, 20 like that. Then out of the, if you take the, for example, practical questions, if there are 3 questions, so you have to answer 3 questions. Then at the final exam, 60 marks for practical, theory part, 40%. But out of that 40, we convert into a range 60%. Then ultimate marks are 24 for theory, 36 marks for practical sessions, practical things. Altogether 100. Then submission procedure, failure to meet assessment deadline. So just read those. Scholarly writing and plagiarism. So we will check the plagiarism also. So we have some equipment, so softwares to check whether you have copied from the other people, from the website like that. So we have a mechanism here. End-term examination. This is 3-hour lab-based examination covering all the topics covered throughout the semester. So if these particular conditions are continuing, then we have to make sometimes lab-based examination. Or otherwise, we can have an exam physically. Program mapping here. Some aspects, introduction part, application, synthesis like that. Some aspects, we expect the indeed to apply more complex models, interpret results, and cooperate report in that part, linked with the synthesis. So, introduction, understand a critical role of finance in developing financial models and use efficiently key Excel functions. Those are basically you have to learn that. So others are at intermediate level. Create forecast income statement, cash flow, balance sheet, etc. So those are our initial explanations regarding the subject. Then we can go to our first session. I think all of you have downloaded the session. Today we uploaded to the website. First of all, we have to understand what do you mean by financial modeling. Financial modeling is the task of building an abstract representation or model of a real world financial situation. So this is a mathematical model designed to represent the performance of financial asset or a business or a project or any other investment. So basically, this is a mathematical based model. You have to understand, even if you consider balance sheet, income statement, that represent some asset and liability. There's an equation. So similar with that, if you develop the financial model based on the forecasting model, income statement, balance sheet, ultimately the model should be represent that particular concept, asset and liability. So the asset side as well as liability side, there should be balance. If there is some deficiency, that can be some mechanism that may be the financing estimation or maybe investment value estimation like that. There is a particular adjustment here. So if you find some other different equations like present value or future value, that is also some development based on the mathematics. You have to derive the equations, then that is developed, the model developed based on that particular mathematical theory or equations. So everywhere, every time, if you develop the valuation model, business valuation model, then that is also based on some theory. That is basically mathematical development. So actually financial modeling is a task of developing some particular conceptual representations, explanations. So first you have to understand that. So that may be based on the economic theory, that may be based on the corporate finance theory, that may be based on some other portfolio or international financial management based, or maybe different kinds, or maybe accounting, inventory valuation like that. The financial model is simply a tool that is built in spreadsheet software such as MS Excel to forecast the business financial performance into future. So there can be some other methods. So our purpose is to use the MS Excel to develop the model forecasting the company performance sometimes. The forecast is typically based on the company's historical performance. So that is based on the past data, 5-year data. In addition, there are some certain assumptions about the future. If you can continue the same way as previously, we can make assumptions, we continue the same trend in the future also. Or otherwise, there are some changes in the market environment. Depending on that, we get make some different assumptions. And requires preparing an income statement, balance sheet, cash flow statement, and supporting schedules. So here indicate the known as three-statement model. Basically, we understand different cash flow estimations are based on the future estimations are based on the balance sheet, income statement, cash flow statement, etc. So here we use the three-statement model. From there, more advanced type of models can be built, such as discounted cash flow analysis, DCF model. So all the type of models are developed based on those estimated values, past data. So we must have basically company profit level, what are the operating cash flows, non-operating cash flows, what are the company core business activities related cash flows, non-core business activities cash flows like that. Then we can develop different models. That may be economic profit model or maybe a discounted cash flow model like that. So here, in order to discount the cash flows, first we have to understand how to develop the different models. So here indicate the DCF models. So you have done that. Then leverage buyout, LBOs, mergers and acquisitions, M&A, and sensitivity analysis. So in different scenarios, we discuss leverage buyout, mergers, acquisitions, amalgamations, or otherwise maybe sensitivity analysis. So in the, we have already learned sometimes those things, but we can develop different models in financial modeling subject. So this is one example for discounted cash flow model. So here indicate if you can read that. So if you remember the concept, discounted cash flow. So here discounted cash flow model assumptions. Basically, you have to make different assumptions as we discussed now. That may be tax rate, discount rate, perpetual growth rate, enterprise value compared to EBITDA, multiples, transaction date, fiscal year end, what is the fiscal year end, current price, shares outstanding, debt value, cash value, capital expenditure, like that. There are different assumptions. Then discounted cash flow model, entry 2018, 19, 20, 21, 22, 23, etc. So based on those assumptions, we can estimate different periods, different items like EBIT, cash taxes, depreciation amortizations, capital expenditure, changes in net working capital, unlevered free cash flow. So without considering the debt consideration, then unlevered cash flow. Then transaction cash flows. Then ultimately indicate intrinsic value. That may be enterprise value plus cash less debt capital, then equity value. So in business valuation theory, we have learned those things. Then we can easily develop the model if we have learned those particular fundamental things. This is one example. So we can explain like the same way we can develop the model for financial statement. For example, basically we have to put the assumptions, sales value, growth rate of sales, what is the net profit ratio, gross profit ratio, what is the operating expenses, like that. Initially, if you have made some assumptions, based on that, based on the past data, we can estimate the income statement figures. We can forecast for the next 5-year period also. At the same way, we can forecast for the next 5-year period balance sheet estimations. That may be equity value, that may be enterprise value, like that. Then financial modeling is useful for many purposes. So what is the purpose of developing a financial model? The output of a financial model is used for decision making and performing financial analysis. So ultimate target may be to develop the model, or maybe develop the financial, making some financial analysis, whether inside or outside of the company. Inside a company, executives will use financial models to make decisions about raising capital. So we can develop the model for in order to estimate the fund requirements, whether it is debt capital or whether it is equity capital. Making acquisitions, business acquisition or asset acquisitions, or maybe growing the business organically. Example, opening new stores, entering new markets. So if there's a business expansion, then we can estimator, we can develop some different scenarios and decide whether it is feasible. Selling or divesting assets and business units. Budgeting and forecasting, planning for years ahead. Then that may be preparation of budgets and forecasting. Capital allocation, priority of which projects to be to invest in. There are different kind of purpose here. So there may be different kinds. Value in a business, financial statement analysis or ratio analysis, or other different kind of management activities. Who needs financial modeling? Sometimes financial control needs this particular requirement. Sometimes the different managers, they observe the ways of deciding their decisions. They must have some particular estimations or maybe some study. So for that purpose, they need financial model. Sometimes the owners, they need some decision-making requirement. They observe whether there is any particular way of solutions. The financial analyst, they need sometimes financial modeling. Present and potential investors. In the market, there are different kind of investors. They can analyze, take in different assets and observe whether there is any feasible area. So, opportunities. Uses of financial modeling allow accurate decision making, less time consuming, easy to use, consistency in decision making. So those are very important factors. So if you take accurate decisions, then better if you have a particular guidance. Correctly estimated values. Then other thing is less time period. Within a shorter time period, you have to take decisions. Easy to use. How even if you have developed the complicated model, practically that should be there should be possibility of applying this particular model in user-friendly way. Another thing is, if you have developed some particular things, then you must be familiar with that, and we must carry forward the same model in the next period also. Consistency. That is very useful. Who builds financial models? So there are many different types of professionals who build financial models. The most common types of career tracks are investment banking. In most cases, investment banking activities, they need financial model building. Equity research, corporate development, accounting, due diligence, transaction advisory, valuation, etc. They need corporate development. For that purpose, they need financial model. So different persons, the managers, they build financial models. How can you learn financial modeling? The best way to learn financial modeling is to practice. It takes years of experience to become an expert at building a financial model. So this is the initial point. First, you have to put forward your steps towards developing initial basic financial model. Then you have to practice that. You can enhance your model. You can think of different scenarios. Then you must be familiar with different scenarios and expert financial model builder. And you really have to learn by doing. Reading equity research reports can be a helpful way to practice, as it gives you something to compare your results to. one of the best way to practice is to take mature companies' historical financials, build a flat line model into the future, and calculate net present value per share. This should compare closely to the current share price of the target. Prices of equity research report. So this is the initial starting point. So there are different sources, then the different scenarios. So we have to think of different applications. There are much opportunities in the market, industry. This is one example here indicate. When you develop the optimal portfolio, then if there are different kind of assets here, he indicate the number of assets, 4 assets here. Then take in the different parameters, standard deviations, some other risk factors, the correlations, covariances, then ultimately develop some particular efficient frontier. So later we can apply the things when we discuss the stock valuation part. So this is one other example. Then you must learn how to apply the particular way of developing the model, then financial modeling process. So that process includes basically 4 aspects: problem conception or problem identifications, model constructions, then flexibility testing, and output summary. Those are very simple steps. Problem conception means understanding the purpose for a model. A spreadsheet is developed in order to aid in the solution of a specific problem. So this is a one particular technique, method, spreadsheet. Problem conception involves constructing a proper theoretical foundation, identifying, evaluating, and documenting assumptions. Then identify input and output variables. Example, what information must the user provide? What results should the model produce? Are there interim calculations? There must be some particular informations. So then you can decide what kind of information we need for developing some requirements. So what kind of results we can expect from the model? So if there are some other different interim calculations, so you can decide that. So before we getting the NPV value, then in the median way there is some other interim calculations. For example, if within the period, if there are 5-year period, first we have to calculate what is the present value of 1-year period, present value of 2nd-year period. Like that, there are some different interim calculations. Second step, model construction. It is the construction of a spreadsheet. So first, we have to identify the problem, the purpose, then you decide how to construct that model. It includes 4 points, 4 steps. Then construction spreadsheet includes 4 aspects here, 4 steps: layout, prototyping, reporting, formatting. Then layout is some particular spreadsheet. You can allocate different purpose for different areas. Prototyping, if you develop some particular case, array, or calculations or estimation, Then we can apply the same thing in the next period also. Then that is a prototyping. Then reporting. So how are you going to report to the top management? There should be some other thing is formatting. So even if you get some particular outcome, you can't present it as it is. So there should be some particular way formatting. Layout, first part of that second step here in the model construction. Documentation area. A, B, C. Description of the problem. First, we have to describe the situation, case. B, in the documentation, you have to mention what is the purpose, solution. Third one, instructions for using the model. So even if you develop the model, there should be some particular instructions, how we are going to use that model. Sometimes the manager or decision maker, they are not much familiar with this particular model. Then input area. First documentation area, then input area in the Excel worksheet. First, we have to allocate for input values. That may be interest rates, number of years, what is the coupon rate, what is the compounding frequency, like that. For that part, there should be some input areas. Then second part is the interim calculations. Based on the input values, before going to take the outcome, there should be some allocation for interim calculations. Then output area. Then here indicate prototyping, layout, prototyping, second point. Then prototyping, unique initial equations that tie the inputs, interim and output areas together. So remember, when you develop some array, then there should be linked with the initial equations that should tie with the input area, interim calculations, and output area together. In that case, you must link with the three areas now together. Then in some cases, if you can enter the values, numbers, you can get the answer initial stage. But if you apply in different scenario, you can get the outcome because you have already entered the values numerically. But there is no link. Instead, you are entering the numbers, there should be other way of entering the link. So there should be some link. So in the Excel worksheet, we can discuss how to make the different links with the different cells, different areas. Wherein initial equations is crucial in spreadsheet constructions. First, you have to, when you develop the initial equations, then you must be familiar with the financial equation first. For example, if you want to get the present value of future cash flow, then you must know what is the financial equations. Do you know that present value can be calculated? Present value equals future value divided by 1 plus discount rate to power t. So that part you must know first. Initial equation, financial equation. Then you must be able to convert it into Excel spreadsheet. So now we discuss how to develop that kind of initial equations based on the financial formula. That should be very important point is the initial equations. If we properly develop that, we can get the correct answers. If you only estimate that, develop the initial equations, then final outcome becomes wrong. Reporting, display of pertinent results. How are you going to display your results? A good model displays in an easily understood manner what the inputs were, what interim calculations values were formed, and what results were generated. So reporting part also very important to report to the top management. If you can take the answers based on the Excel worksheet, but we can report as it is. So with that results, we have to develop some way of presenting to the management. Then other part is formatting. Include assigning the proper numeric format, highlighting important results, and delineating separate spreadsheet areas. Sometimes when you format the model, there are different mechanisms. Sometimes you have to assign some way of presenting that numbers. Sometimes you can color that, that one side of numbers. You can highlight some other parts. You can use the different colors, or maybe you can allocate different spreadsheets. Worksheet 1, worksheet 2, worksheet 3, like that. You can allocate different spreadsheet worksheets. So when you prepare the submit to the top management, there should be some formatting requirements. Then third point is that flexibility testing. Even if you have developed the model, it is not workable if there are some errors. If there are some changes in the model environment, that should be easily adaptable. So that is called flexibility testing. Does the model quickly adapt when variables or assumptions change? So you must be able to quickly adjust the model when there are some changes in one particular variable. Does the input area account for all the necessary model inputs? Then in the input area, there should be proper allocation for required model input values. Can a change in a prototype equation be efficiently copied throughout the relevant range? If you develop some particular array or way of estimating the requirement, that should be properly copied to other ranges. Then we can get the answers the same similar results like similar purpose in different periods throughout the periods. Can expansion or modification of the input area be accomplished quickly? So if there are some expansion or modification, then there should be way of incorporating that things. Does the model accurately account for all facts of the problem? Then we must be familiar with whether that particular model is accurately measure the things, as well as whether all the facts are incorporating your model. Is the model consistent throughout? Then once you develop the model properly, throughout the periods, you can apply that same thing, same model in consistent manner. Then there is a flexibility requirements. output summary. After all the work of understanding the problem, laying out a logical model, and generating a solution. This solution must be present in a well-written, competent fashion. Then, once we develop the model, then ultimately there should be proper output summary. So that may be one particular one figure value, maybe NP value, maybe future value like that. So, or maybe there are some other similar outputs, like at the same time, you have to show that corresponding other parameters, like maybe some internal rate of return, maybe some other feasible time period. So like that, there can be different output summary. So here indicate some rules of financial modeling. There are certain rules. So when you develop the model, there are certain rules. These rules will help you build better spreadsheets. Readability, logic, simplicity. This is what you should strive for. So in order to get the accurate model, then there should be some particular principles here, rules. Rule 1, try to put variables in input variables in one place. You indicate, highlight in that area, interest rate 8%, annual deposit 12,000, annual cost of college 35,000. Those are input values. Those are should be those the input value should be located in one particular place, not in here and there. They indicate critical parameters, sometimes called value drivers, are in the upper left hand corner. The actual of savings for a college education is discussed in some particular chapter here indicate. So requirement is you have to put similar input value, similar some particular location, some input values. So you indicate then calculations. Then end of the row here indicate row number 20, NPV of all payments. So within that, in between input area and the output area, there are some different estimations here. Process. Rule 2, don't hardwire numbers. Use formulas instead of numbers. So, as we explained earlier, there should be linked with the input area and the interim calculation as well as output areas. So between the input area and the interim calculation part, there should be some particular link. So in Excel worksheet, we can develop in different way, linking the interim calculation as well as output area. So that link is based on the financial theoretical explanations, requirements. Now we can discuss some Excel functions using Excel in financial modeling. So here we discuss some more important Excel functions. So normally the Excel functions include financial functions, math functions, conditional functions, text functions, statistical functions. Here indicate when you the financial functions, normally you must know how to access that financial functions. So here in the insert, here we can select the appropriate requirement here. Whether it is average estimations, whether it is standard deviation, whether it is regression model application like that, we have to select what is the requirement. So you know that in other courses you have learned those things, how to use the different Excel functions. So from time to time we discuss in some way the available functions as well as what is our own development. They given some example. NPV. NPV example is given here. The discount rate is 10%. Cash flows are 100, 35, 33, 34, 25, and 16 from year 0 to 5. Calculate NPV. So this is a simple example. Then how am I going to estimate the NPV value? So now first we can open Excel worksheet. So we can simply start from this particular simple example. Later on we can familiar with the Excel functions, then we can develop our own functions. Then we can open Excel worksheet. We can start now with that some explanation what we learn discuss now. We can try to get some answers. So in this case, what is the method? So here, basically, your requirement is, you can say, NPV calculations, estimations. Then first you can enter the different parameters, input values. Then you indicate discount rate is 10%. Discount rate 10%. Now open the Excel worksheet. At the same time, you try to practice this one. Then cash flows. So how are you going to enter the cash flows now? So here you can say time period. Cash flows are negative 100, 35, 33, 34, 25, 16. Then initial one is a negative one. Then time period 0, time period 1, 3, 4, 5, like that. Or otherwise you can enter the time other way, horizontal way, using the rows. So like here, you can enter the time period 0. So in any way you can apply. The layout can be horizontal or vertical. That is your preference. So initially, so you can enter the cash flow. 0 period, negative 100. Period 1, 35, 34, 33, 34. Then 25, 16. Then we know that input values are 10% rate, discount rate, cash flows are beginning of the period, year 1, year 2, year 3, year 4, year 5. Those are positive cash flows except the initial one. Then when we are going to calculate the NPV, so now we are discussing how to use the Excel. So there are different methods here. One is you can use the available Excel functions. Then one method is you can estimate the value here, present value of each cash flow. As it is the initial point, we can discuss the process. Then we can apply this is the Excel worksheet. Now present value of each cash flow here, we can see now cash flow when you enter the some equations, then first we have to, when you are going to estimate the value, first we have to enter the equation sign. Then cash flow, then divided by within bracket 1 plus relevant discount rate here, relevant discount rate, close the bracket. Then in Excel, we know that when you calculate the present value, cash flow should be divided by 1 plus discount rate to power t. Then power t or exponent we can use in the Excel worksheet using this particular symbol. Press shift and this particular symbol that represents the exponent. Then what is the exponent here? Exponent is time period. Then we can enter the figure, then we get the 31.818. So in this case, can we copy this array, this equation into other ranges? We make a mistake here. What is that? Now our plan is to use this equation to other ranges, year 2, year 3, year 4, year 5. Can you copy this one to other ranges? What will happen? We get the same value here. What is the wrong with this? Then initially, when you develop this array, then you have to remember how we are going to apply the this particular cell references. We call that cell references. Referring to this particular discount rate, 10% rate, we use here B3. So when you copy that array into other ranges across the other periods, what will happen is here if you review this one, D6 divided by 1 plus C3 to power D5. D5 is the time period. Is it correct? C3. D6 divided by within bracket 1 plus C3. C3 means what? C3 means here there is no any figure here, but we have to use this particular rate, the discount rate. So in order to use the same rate, then you have to make a modification here. Then B3 should be locked. We have to use the same rate in period 2, period 3, period 4, period 5. So in order to lock the column and row, we call that lock the column and row. Column number B, row number 3. We have to lock that. B3 should be constant value. Then we have to press F4. $B$3. It means we log the column and row number 3. Then we can copy it across the periods. Now we get the correct. And now you can check that column D, row number 7 indicate here equation D6. D6 means this corresponding cash flow divided by 1 plus B3, same rate, to power D5. D5 means time period 2. Next one, same way, corresponding cash flow divided by 1 plus constant discount rate to power time period 3. Then in this case, if you follow the same one here, if the cash flow is 100 divided by within bracket 1 plus discount rate, this one, to power time period 0, we get the negative 100. If the exponent is 0, we get the same answer. Then NPV, net present value, how to get that? Then we can get the summation of all these present values. Enter equal sign, sum within bracket, go to that range, close the bracket. Then 11.64569. Then NP value is 11.645. Anyway, now you can redo the decimal places. So in spreadsheet also, you can reduce the decimal places if you wish. Now that indicate input values here. The discount rate and the cash flows are there. Then you can calculate the present value of each cash flow. Then here, if you want to highlight this particular parameters or indicate some highlight little bit, then highlight the year. Then these are the interim calculations. So we could have get the answer here. For example, first year cash flow here. We could have get the answer here. We can enter just 35 divided by 1 plus discount rate 0.10, exponent, if it is a time period 1, 31.81. So what will happen if we copy this one to other ranges? We get the same answer. So that's why we mentioned don't use hardware numbers. We don't use the numeric values here. We can't copy. We can copy, but we don't get the correct answers. So there should be some link between the cells. So here, this cell link with this cash flow, discount rate, and time period 1. This cash flow link with the cash flow, discount rate, as well as time period 2. So this link with the NP value here, summation. So altogether there are links. So now our purpose was to how to use the available functions. So NPV we can say use in Excel function. So we got the answer here. NPV using this is called timeline method. Timeline. So here timeline is period 1, period 0, period 1, period 2, period 3, 4, 5 like that. Timeline. So now we are going to get the answer based on the Excel functions. So how we are going to take the Excel functions here. Then we have to select the FX here. Then select then you can select financial function. There are different estimations here. Future value, NPV, then in order to get the NP value, then we have to estimate, enter the what is the discount rate. Then according to the Excel available functions, the values are we can take from the period 1 to 5. Then we can eliminate the initial investment value. Otherwise, we can say that minus initial investment. So normally the Excel worksheet is developed based on the certain assumptions so here initial value is negative value, others are positive values. So if you just enter the NP value based on all these cash flows, it does not give the accurate value. So based on the year 1, year 2, year 3, 4, 5 like that, then first we can get the present value of all these cash flows minus initial one. Then we get the answer here. Then enter the day, discount rate. So you indicate the explanation. Return the net present value of an investment based on a discount rate and a series of future payments, negative values, and the income positive values. So you indicate the future payments negative values and the income or positive values. So here we can take the different cash flows here and get the value and eliminate the initial investment, but they indicate that future values are negative values and the incomes are positive. So then we have to add the initial value here. Then we get the NP value. So the another one is the NPV using equation. then how are you going to take the present value of each cash flow? Then already we have calculated that value. Then we can't take the estimate the NPV value using the one particular equation. So if it is the similar cash flows here, we can use the equation, present value annuity factor. But in this case, we can't use the one particular equation. Already we have estimated the cash flow, present value of cash flow, and ultimately we got the NPV value. Now we can see the next example, IRR, internal rate of return. So in order to calculate the internal rate of return, so here indicate NPV equals summation T1 to N cash flow divided by 1 plus discount rate to power T minus initial investment. So period 1 to N, we can estimate the present value of cash flow and get the summation, eliminate initial investment. At this point, here indicate if the NP value equals 0, if you see this equation, NPV equals 0, summation cash flows at time period T or N divided by 1 plus internal rate of return to power T. Then ultimately the value equals 0. It means this particular rate is will give the NPV 0. Or otherwise here we can use the particular equation in your financial class. You may have learned that internal rate of return can be calculated using this equation. RA means lower discount rate plus NPV value at and the A rate, lower rate, divided by NPV at lower rate, it means A rate, minus NPV at another rate, B rate, higher rate. RB equals high discount rate. Here should be RB equals higher discount rate multiplied by difference between two discount rates, RB minus RA. So this is the financial equation. This is the idea. This is the estimation of cash flows, present value of future cash flows minus initial investment. Then we get the NP value. If the NP value becomes 0 value, at that time, at this point, the corresponding rate, discounted rate is the internal rate of return. Then from the using the equation, we can calculate that based on this one. Then we have to use the trial and error method, or otherwise we have to use this kind of equations. This equation is the lower discount rate plus NPV value at that lower discount rate divided by NPV at that lower discount rate minus NPV at high discount rate multiplied by difference between two discount rate. Then we get the answer here, internal rate of return. So however, in this case, discount rate, here given the 10%, cash flows are different. In that case, how to calculate the internal rate of return? Then we can use the same Excel worksheet. I think you can see now the again Excel worksheet. So now if you want to calculate the internal rate of return, IRR, then equal sign IRR within bracket, you have to give the corresponding cash flows B6 to G6. Then we get the rate 15%. So IRR can be calculated here. This is the Excel function IRR. Then you have to give the values. Then the rate becomes here 15%. Then using the Excel functions, or otherwise you can estimate the rate based on some system that we can enter the equal sign, enter IRR, within bracket we have to give the cash flow range values. The next one here, third question, you indicate calculate IRR for above. The next one, future value, calculate future value of 5 annual deposit of 1000 rupee at 5% rate when deposit beginning of the year, at the end of the year. Then now we have to calculate the future value if there are 5 annual deposit of 1000 rupees. Then there is the annuity. Now again we can see the cash flow worksheet. Future value of an annuity. So in this case, input values are discount rate is 5%. 5% rate, number of periods, number of years or periods, 5, cash flow, or we can say annuity. Annuity 1000. Now we have to calculate the future value. So you have two different options. First, we can use the timeline method. 0 to 5-year period, enter the cash flows, then calculate the future value of each cash flow and get the summation, then future value using timeline. Then again you can get the answer using Excel worksheet. So similar way that periods are here, 0 to 5. Cash flows are here. So annuity values are there. Then in the initial no annuity value, at the end of year 1, we can use this K5. So when you copy this one to other ranges, other periods, we have to log the column and row. We can log the column K, row number 5. Now here indicate the equal sign K5. Log the column and row. Then you can copy to other ranges. Then you can calculate future value of each cash flow. So here, first year cash flow here should be multiplied by, then now we have to remember the financial equation. Multiplied by 1 plus discount rate. Then now think of how to apply this one. Now you have to copy this equation to other ranges. Then we have to log the column and row, then press F4, close the bracket, exponent, time period. What? Now you have to think of. First, you can indicate number of periods here, K4, that should be constant number minus corresponding period is 1 here, L7. Close the bracket. Now see again. Equation is L8, the corresponding cash flow, multiplied by 1 plus K3, constant K3, discount rate, exponent. Again, we put in within bracket, K4 means number of periods 5, number of years 5, minus what is the corresponding period here, year 1. You consider the cash flow at the end of year 1. Then we have to eliminate the year 1. Then now we can copy it to other ranges. Now see last cash flow here. The last one occur at the end of year 5. At the same day, on the same day, we have to calculate the value. Then here there is no corresponding time gap. Then here exponent should be constant time period 5 minus P7. P7 means 5. The exponent becomes 0. Then if the exponent becomes 0, then we got the same cash flow here. Then we can calculate future value equal sign sum within bracket. We can get the total value of this estimation, 5,525.631. Now try to get the future value using Excel. Excel function. Then get you the function here, future value, then discount rate, corresponding rate is 5%, number of periods, corresponding period, then payment is 1,000. Then type here indicate, what does indicate the type? Type indicate the return the future of an investment based on periodic constant payments and a constant interest rate. Then type here indicate is a value representing the timing of payment. Payment at the beginning of the period, 1. Payment at the end of the period, 0. If the payment is period at the 0, then we can omit that. Then here we can indicate all the cash flows occur at the end of each period. Then we can omit that, or otherwise we can enter the 0 value here. We get the 5,525.63. So in order to eliminate this dollar sign, we have to make some modification. Right click, format cell. We can enter the numbers or general. Then it eliminates the dollar sign. So other method is not like other future value or present value, NP value. We can estimate the future value using equation. Then you must know what is the equation. So what is the equation? So you must remember the equation. So when you calculate the future value, then I will enter the equation here using the text box. Somewhere here, FVA, future value of an annuity, equals payment or annuity multiplied by 1 plus discount rate to power n minus 1, then the total divided by discount rate. Then now remember that equation, present value, future value of an annuity can be calculated here, payment multiplied by 1 plus discount rate to power n minus 1 divided by discount rate. Now we can develop the array here. We can enter the equation. Payment is here, annuity value here, multiplied by, within bracket, 1 plus discount rate is 5% rate, 5% rate, exponent, time period 5, time period 5. Then again here you have to put the, open the bracket, because there are two close bracket here, minus 1, again close the bracket, then you have to put the, again here 1 bracket here, divided by discount rate 5. Then we get the answer here, 5,525.631. So now we got the answer here, future value using timeline method. Timeline. Second one, future value using Excel. We got the using the Excel here. Future value using equation. So we develop the some small array here. So you have to remember this development. Then in addition, if you want to use the Excel function here, one other method is there. We can enter the equal sign, future value, just enter the FV within bracket. Here indicate the necessary parameters. First one is rate. Rate is 5% rate. Then here indicate the NPEI. It means number of periods here. Periods 5. Payment is cash flow 1,000. So here we have to enter the negative sign for the cash flows here. Otherwise we don't get the positive value. Later we can enter the negative one. Payment is K5. Present value. Do we have a present value? We don't have. Then we can put another comma. we can keep as empty. Then here indicate whether the cash flows occur end of the period, beginning of the period. Then if it is beginning of the period, end of the period, we can assign 0 or we can omit that if you like. Then we get the answer here 5,525.63. If you want to get that answer entered in the, if it is the end of the period, we can assign 0. We get the same answer here. In order to eliminate the dollar sign, we can select the numbers here. So here, as it does not enter the negative sign for the cash flow, automatically we got the negative values here. The thing is, we can enter this particular cash flow payment as a negative. Then we get the positive value as without consistent with the initial. So it is Excel is developed based on some cash flows. If it is if there are no any other indication, it count as a negative. So if you want to get the positive one, if there are no specific sign here, then we can assign negative sign, then automatically get the positive value here. Ultimately, even if you get the existing Excel functions, then ultimately here indicate that particular equation. So when you select this function, then when you enter the cash flow, then we can assign negative. Then we get the positive value here. Now, from these calculations, one important thing is you have to identify when we develop the link. When you use the link here, cash flow divided by constant discount rate, 1 plus constant discount rate to power time period. So we use the some two kind of references. One reference is as it is C6, B6 like that. So this is called relative cell references, C6. Relative references. Then other one is here, we log the column and row. That is called absolute cell references. So when you develop the arrays, we use the two kind of references. One is absolute cell references, other one is relative cell references. Relative means we consider the some corresponding cash flows. When you copy it to other range, other cell, then we copy the other range, other cells value. That is called relative. If it is absolute, we use the same parameter. We have to log the column and cell. That is called absolute cell references. Then we can see the other ones. Next one, present value. Payment of 1,000 rupee, 100 for 10 periods at 10%. Calculate present value if cash flows occur at the end of period and at beginning of period. So the example was we have to calculate for both this method. So now also here indicate the beginning of the cash flow, end of the cash flow. Early case, if you consider the here the cash flow here, end of the period, this process is correct. But if the cash flows occur beginning of the period, then normally financial equation here, same equation, if you remember, we have to multiply this equation by, if it is beginning of the period, this should be multiplied by 1 plus discount rate. That is the only modifications. If the cash flows occur beginning of the period. Otherwise, we use the same way. Then if it is a beginning of the period, then here we can calculate the value, future value equal sign, then discount rate, comma, number of periods 5, payment negative K5, as they are in no present value, then beginning of the period we can assign 1. Then we get the answer 5,801.91. If you want to use the same equation, then if it is beginning of the period, this should be K5, 1 plus K3, time period K4, exponent K4 minus 1 divided by K3. This equation should be multiplied by 1 plus discount rate. You get the answer 5,801.91. Now see again, equation is K5 multiplied by 1 plus discount rate to power K4 minus 1 divided by discount rate, then multiplied by 1 plus discount rate. The next example, present value. Is actually not difficult. Payment of 100 for 10 periods at 10% rate, calculate present value of if cash flows occur at the end of the period and at beginning of the period. Then here financial equation, present value, cash flow divided by 1 plus discount rate to power T. So here indicate the payment of 100, then that is annuity. If there are 10 periods, one payment is a similar value, then we have to calculate the present value of annuity at the rate of 10%. Conditions are beginning of the periods, end of the period. Then if you want to calculate this one using the Excel functions, then we can calculate the value present value of an annuity. Then the cash flows here, input values, annuity value or payment 1000, discount rate is 10% rate, discount rate 10%, number of periods NPER, number of periods 10 periods. Then we have to calculate the present value. Then present value is in Excel function equal sign PV here. Then rate is 10%, number of periods 10, payment is, you have to assign negative, then type is whether it is end of the period, whether it is beginning of the period. If it is end of the period, we can ignore this type, then enter the equation. 6,144.57. You can eliminate this currency representation. Then, if it is present value in the Excel, but if the cash flows occur beginning of the period, Excel, present value, rate 10%, number of periods 10, payments negative 1000. So here also same, you have to use the cell references. Don't enter the manually the numbers. In some cases, we have to do the same equation in other cases. Then pivot value type, we can indicate in the beginning of the period, we can indicate 1. $6,759.02. Present value, if the cash flows are beginning at the period. Here we indicate the present value. Cash flows are end cash flows. 6,144.957. Now, if you use the timeline method, so how we are going to take that? Then we can say, for example, here period (0 to 10). Then there are different cash flows here. No, similar cash flows. Then we can enter the cell reference R6. We can log the column and row. We can copy it to other ranges. Then present value of each cash flow. Then equal sign cash flow divided by 1 plus discount rate 10%. That is constant one, same rate. Exponent time period 1 in this case. Relative reference is S13. Then we can copy across the periods. Then we can get the present value. Then get the sum of all these cash flows. Yeah, if the present value, if the cash flows are beginning of the period, if beginning cash flow, then how we are going to calculate the value here? Then the calculations here, cash flow should be divided by 1 plus discount rate 10 exponent should be starting from period 0, because this cash flow occur beginning of the period. It means we have to start from here. R13 1,000 so in that case, total value is if it is the beginning of the period 6,759.024. So here you have to make the correct process mechanism here. Then time period should be 1 year before. 1 year before. Then for the last payment here, for this payment, deposit or whatever the cash flow, then present value is there are 10-year period, 10 periods. For this one, there is no periods. On the same day, we calculate the present value. So in this case, if the end of the period for this amount, we have a 1 period here. For the last payment, there are only 9 periods. So automatically it calculates present value based on that. If the period is 10, automatically count the 9 periods. The worksheet is developed based on that principle. So in the meantime, you have to save your workings. Otherwise, we can continue. We can't continue using the same thing next time. Then better you can save your workings wherever you are working. If it is desktop, you can save your workings. Excel function for anything. You can name as then if you read the next one, next one asks the loan of payment, annuity value. Loan of 1,000 rupee to be paid over 10 years at an interest rate of 8%. Calculate annual payment if happens end of period and beginning of period. Now you have to calculate the annuity value. Then the information given, loan of 1,000 rupees. It means now you are going to take 1,000 rupees from the bank, then that is present value. Number of periods 10. Discount rate is 8%. So in this case, you know the loan value or present value of annuity. So this is equal to present value of an annuity. Then maybe 1 million, 10 million, or any value here. You indicate the 1,000 rupees. That is loan amount. You are borrowing that value. But after 1 year period, after second year period, you have to pay loan repayment. Then the installment is normally same. So in that case, you have to calculate the payment, annuity value. So how are you going to calculate the that value? Within the Excel functions, within the your equation. Now you must know the equation, financial equation. Then present value of an annuity. So here should be present value of an annuity. Then what is the relevant equation? If you know that equation, you can develop the array function. If you are using the Excel function, then estimation of payment or annuity. And the discount rate is discount rate is 10%. Number of periods 10. NPER, number of periods 10. Present value of an annuity, PVA, 1000 rupees. Then using the Excel, you can calculate the present value or payment. Then you can use the payment Excel functions, then PMT. So here indicate PMT. PMT means calculate the payment for a loan based on a constant payments and a constant interest rate. Constant payments as well as constant interest rate. Then discount rate is 10%. Number of periods 10. Then the present value is, here should be negative 1000 rupee. Then cash flows occur end of each period. Then you can get the answer here. Annuity value is 162.75. If the cash flows occur beginning of the period, then we can apply the same way, PMT, discount rate 10%, number of periods 10, present value is 1000. If you have not put the negative sign, then enter here negative. Type is, we can enter 1 if it is beginning of the period. So you have to pay your installment beginning of the period. Then that should be 147.95. Then here, if the payments are estimated based on your own equation, then you have to remember the financial equation. Then PVA, present value of an annuity. PMT using your own equation. Then normally that equation is, if you remember, then we start from the payment multiplied by, within bracket, 1 minus 1 over 1 plus discount rate to power n, then total divided by discount rate. That is the equation. Payment multiplied by 1 minus 1 over 1 plus discount rate to power n divided by discount rate. That is the equation. So now we have to put in a Excel function, Excel arrays. Then you have to put the equation sign. Now using that equation, our purpose is to calculate the payment. So in order to calculate the payment, present value of an annuity, it means that 1000 rupee should be divided by remaining part of the right hand side of the equation. Then if I write somewhere here, equation, insert text box, I will just enter the equation here. Normal equation is PVA equals PMT within bracket 1 minus 1 over 1 plus discount rate to power n here should be open the bracket and the close the bracket here, divided by discount rate. So this is the equation. So now we want to calculate the PMT. Then this PVA should be divided by second part of the right hand side of the equation, this part. Then we can enter here equal sign present value of annuity be 19 divided by except PMT, we have to enter the remaining part of the equation. 1 minus 1 divided by 1 plus r to power n means we know mathematically we can take the value here 1 plus discount rate close the bracket negative n. Negative n means number of periods here 10. 1 over 1 plus discount rate to power n, that should be 10. Then we consider rearrange the equation. We can rewrite 1 plus discount rate r to power negative n, then negative 10. Close the bracket. Divided by discount rate. Here should be a exponent. Exponent time period 10. Then the payment is 162.7454. So this is the equation. So in order to get the beginning of the cash flow, then this equation should be multiplied by 1 plus discount rate. Then we get the 147.95. Now better you can save your workings. So next time we can continue with the same spreadsheet So if you have any questions, you can ask two questions. Why did we get that as a negative value? So normally the Excel worksheets are developed based on some basic some requirements. So the initial investment normally it automatically counts negative value. So already if we have entered the cash flows without considering that sign, it count as a negative sign. So that's why if you want to get the positive value here, if there are no initial investment, we have to get the present value of future cash flows. In that case, we can assign the negative sign. Then we get the positive value. So when you practice that, you can realize that. Another question is assignments group be allocated according to CPM numbers. So we can decide that later. So I will discuss with our staff members, and if you can arrange your own groups, we can allow sometimes. That may be one better way. So I will decide the group number of members depending on the number of students in the classroom and the number of companies available in the share market. So later we can decide that. So that is the thing. We can stop now. We can continue next time. Okay, thank you very much.